But I think the bigger issue is that they have got I would call it the sort of the biggest housing bubble in history. I mean, it's kind of off the scale, and it's
You
really
mean
got to
their
the point.
history or just, all the world?
No, all world history. I mean,
Right.
it is the biggest bubble. We thought. I mean, if you cast your mind back to the late '80s, 1990, we had a massive bubble in Japan, a housing bubble, and we thought that would be the biggest bubble ever, based on any metric like rental yields, price to rent is the other way around, or just actual size relative to the economy. But no, China is off the scale even compared to Japan, and the numbers are staggering. That the total valuation of Chinese real estate is, conservatively $100 trillion, which is bigger than the global economy, twice as large as the next biggest real estate market, which is the US. And again, conservatively, I think there's about 100 to 130 million empty homes.
The global economy may already be in a recession. What exactly does this mean? What are the implications of a global economic slowdown? Where should we invest? And what will happen next to the labor market? These are questions we'll be exploring with our next guest, Dhaval Joshi. He is currently the chief strategist of BCA Research's Counterpoint service. Prior to BCA, Dhaval held positions at RAB Capital. He was a global strategist at Societe Generale, as well as an investment manager at JP Morgan Fleming. Thank you very much for coming back on the show with us, Dhaval, for spending time with us and educating us. Appreciate it.
Thanks for inviting me back.
Let's talk first about the global economy. You were telling me offline that we could already be in a recession. Well, not we, particularly in the United States, but perhaps outside of the US. We'll talk about the US in just a minute. You were calling for a recession to come. Have we already seen this global recession play out the way you anticipated, Dhaval?
Yeah, pretty much so. So I'm going to sort of qualify that comment and say when we have a global recession, typically it's not actually a contraction of GDP. That does not happen very, very often for the world economy. It's only happened three times in the last 100 years. There was a Great Depression, the Great Recession of '08, and the pandemic. Outside those three occasions, a global recession is typically when growth slows to 2% or below. So if we think about, the '90s recession, the '80s recession, the dot-com bust, that's what happened. Global growth slowed to below 2%. And we're kind of there now, right? So to me, we are in this, in this sort of at this sort of tipping point where you can say we are in a sort of not a catastrophic recession like the Great Depression or the pandemic or GFC, but a more typical recession. And we can sort of get to this intuitively by saying, look, China is probably growing below 4% at the moment at best. Um, US is probably around two, if we sort of average out the last couple of quarters, and Europe's zero. So once you sort of average out those numbers, zero, two, four, you're getting close to 2% at a global level. So yeah, we are, in my mind, pretty close to, if not already, in a global recession. You can also see it in terms of the investments which would be most exposed to global growth, like the sort of commodity industrial commodities. Look at Germany itself. The German economy is, if you like, a sort of high beta play on global growth, as is Sweden. Korea, Sweden and Korea have been sort of flatlining. Germany's, had negative quarters recently. So all of this is adding up to quite a dramatic slowdown in global growth, as I was alluding to when we last spoke, which was, I think, what, 4 or 5 months ago.
Yeah, just a couple months ago, exactly. Um, You were also calling for something similar to hit the U.S. We'll talk about the U.S. in just a minute. Your call is not unlike calls from other economists. The IMF actually early in the year had called for up to a third of the world to be in a recession by 2023. Um, you've already mentioned a few countries that have officially been in a recession. I think Germany, New Zealand is another one. China, we'll talk about China now. Their youth unemployment numbers have been so bad that they've stopped publishing them. They've seen deflation. The Chinese central bank has cut rates unexpectedly recently. Are they in a recession already?
Well, again, not in an outright recession by in terms of contraction of the economy, but in China, if you're growing at 4%, or it could even be below 4%, we don't know exactly what the number is because there's a lot of smoothing of the statistics. But yeah, I mean, remember China was growing at double digits for many years. So to slow from double digit growth, 10 to 12% growth to even 5%, that's a major shock in China. And we think it's below 5%. It's in my view, it's below 4% right now. Also, bear in mind that this goes against the expectation of a very strong post COVID rebound. That once all the lockdowns were removed, everyone thought China is going to rebound very strongly on a sustained basis. In other words, it wasn't just going to be a 1 quarter rebound; it was going to last through 2023. That simply hasn't happened. So in that context, it's also quite a surprise to many China observers.
Have you noticed an uptick in unemployment in the OECD countries outside the US?
We haven't seen. I mean, it's we're sort of at a kind of inflection point in many countries. Now, in Germany, there has been, by the way, in line with its actual technical recession. In fact, in Germany, the unemployment rate is quite close to where it was in the pandemic, at the pandemic high. Now, we should again qualify that, which is that the pandemic rise in German unemployment was not actually that high because they had this thing called the Kurzarbeit scheme, where government encouraged companies to keep workers on their payroll, so that they didn't have to fire them and then rehire them. So unemployment didn't go up that much during the pandemic. It did still go up, and we're not actually that far from that high that we reached a couple of years ago. So yeah, there are major economies in the world where we are seeing a noticeable rise in unemployment. Germany is a major economy, right? So there's certainly some evidence of it.
The FTSE 100, for example, has been on a downturn all year, while the S&P 500 and the Nasdaq have done the reverse. So is the U.S. market more or less insulated?
Well, yes, of course. I mean, if we look at market-based stock indexes, and that's what we normally look at. Of course, the largest stocks in the US have been doing their own thing, and everyone, we know what they call. They call the Magnificent Seven or the whatever the Super Seven. So one way we can think about it is look at equally weighted stock indexes, right? So you're not giving any additional weight to any stock; you're just going to give an equal weight. And then you're getting a sort of interesting story, which is globally the market's just gone sideways. So the equally weighted MSCI All Country World, it's just basically been going sideways, maybe very slightly up on the year. The equally weighted S&P 500 is up, but nowhere near as much as the actual S&P 500. So yes, the US has done a little bit better than the rest of the world. So the S&P equal weighted is doing better than MSCI All Country World equal weighted. But then you've got this big gap to the actual S&P, which is due to these superstar stocks, which account for most of the move. But yeah, there's been a little bit of insulation, I can say, from in the US to reflect, let's say, the US economy. As I said, going back to the beginning, I said, look, you've got China just slow down very sharply. Europe's sort of stagnating, and the US is sort of trundling along at sort of not spectacularly, but it's sort of growing at whatever 2% or so. So that kind of explains a little bit of the difference in the US stock market versus the world stock market.
I understand. I suppose for the investor watching, he might be wondering to himself or herself, look, the economy outside the U.S., where the economies outside the U.S. may be slowing down, but my portfolios have been going up if I just invested in some U.S. indices. So ultimately, does it matter for me? They might be wondering. How would you respond to that?
Well, it does matter because, in a way, what we're saying is, look, if you're saying, hey, my portfolio's done really well, even though the economy hasn't, there has to be a specific reason why that is, and we know what that reason is this year, which is that you've had this sort of tech boom in a very narrow range of stocks. And therefore, the way I would flip that around, I'd say is you've got to be really confident that that boom is justified, because if it's not justified, there has been a decoupling between, as I say, a handful of stocks, the rest of the market, and the global economy. And of course, it's going to reconnect in the other direction. So that's the other thing I would ask is, is the ebullience, the euphoria in AI as justified as some people think? I'd be questioning that as well. That's a big question mark, susceptible to the slightest bad news, as we've seen in the last few days with Apple, right? So suddenly there's a risk that Apple, and obviously the stock's taken a hit. So that could apply to any of these stocks that have done extremely well. The tiniest catalyst could send them lower. So you've got to be really confident that this rally is justified. I'm not really convinced it is, because the sort of the growth rate that you would need to see in Nvidia sales over the next few years, for example, it has to be phenomenal, continued for some time. And I think that's questionable, because yes, they can sell their chips to these large companies. They're selling them at something like $300,000 a pop, for one GPU board. So of course, there's large companies that can afford that at scale. But once you get through that sort of low-hanging fruit, can you keep growing your sales at this phenomenal rate? That to me is a big ask.
So going back to your original point about AI stocks, what do you think is going to happen to valuations next? Do you think it's already very much richly priced in, or do you think there's more room to climb?
Well, the thing is that everyone knows that, we know that AI is going to be a very impactful technology. But the question is, and this is really the big question, is how can these companies ring fence or put a moat around their profits? That's really the question, because typically, with innovations, the innovation is great. With the internet, it was obviously a massive innovation. It's changed the way we work, it's changed the way we live. But interestingly enough, between the mid 90s and let's say 2010, tech stocks did not outperform. They did during the bubble, but then they gave it all back. But then subsequent to 2010, tech stocks have had a sustained outperformance based on very strong profits. But that in turn is based on the network effect, right? So what you found in the second part of the internet boom, Web 2, it's called Web 2.0, this was really about networks, social networks and shopping networks and so on. So you had these sort of winners in each segment. So you had Amazon in retail, Google in search, and so on, and Facebook in social media, right? So you get these leaders, which are basically oligopolies. Their profits can grow on a sustained basis, but can the same thing happen for AI? I'm not convinced it can. So that would mean that longer term, it's some of the valuations are hard to justify.
When you're evaluating tech companies and their valuations, their PEs and other valuation metrics are already higher than other industries. So how would you make the evaluation that a particular tech stock is perhaps under or overvalued? What peers would you even look at?
So I would there's two ways I would do it. I would look at against, the very basic way of looking at it is against the market and saying, what's the premium you're paying for the stock or the sector versus the market? Because that premium would require a sustained growth premium, right? And as I said, in the first internet revolution of Web 1.0, the growth of profits in tech did not outperform, over that sort of 20-year period, and therefore that premium that was there at the beginning was not in the end was not justified, right? And that's why you had this sort of bubble deflating. In the second part of the tech revolution, Web 2.0, it was justified. So that premium, was justified because the growth of those profits, beat overall growth substantially. So that's where I would think about it. I would think about it versus the market. I would also think about it versus other growth sectors. That's the key, which is that here's one growth sector. It's on a premium of X. Here's another growth sector. Where how does it, what's the premium on sector Y? So at the moment, for me, what stands out is, 'cause for me, I think that healthcare and certain pharmaceuticals are also growth, but tech is trading on a substantial premium. So I would actually be tilting my portfolio a little bit away from tech towards healthcare and pharmaceuticals, which have kind of been forgotten because everyone's sort of just been piling into tech as the only sort of growth play, and I don't think that's right.
What would you say are the main risks for other countries outside the US to fall into outright contraction in economic growth?
Um, well, I think in a way, when we look at the developed economies, it's a sort of similar story. Yeah, as the US. I mean, when we think about the UK, which is where I'm based, it's there's sort of quite a strong parallel, which is that, look, we've had this high inflation and central banks have to bring it down. And the question is, can they bring it down, on a sustained basis to 2%, or, just below 2% on a sustained basis without killing the economy? And that's the same question in the UK. It's probably the same question in most of Europe as it is in the US. So that's really the big risk, that people have sort of thought, hey, they can do it. But all the signs are saying that the higher rates are very, very slowly and at a sort of different pace in different economies are starting to take an effect. And the way I call it, the way I sort of phrase it as, Goldilocks is a fairy tale. And what I mean by that is the idea that you can kill inflation and just get it out of the system and sort of extinguish it without having some impact on the economy. I think is going to be a really, really tough ask.
So you're in the no soft landing camp.
Well, what I'm saying is this: look, you can avoid a recession, but then you won't have killed inflation. So it's you could, what I mean by that is, if you mean soft landing is recession, economy only, yes, you can avoid that recession. But what will then happen? What will then happen is inflation will not be, inflation will be still hovering around sort of 2.5%, 3% or so. And then suddenly you think you've done the job, you loosen policy, and that to me is like, that would be like sort of dousing gasoline on a fire where the embers are still, haven't died down. Suddenly the flames are just going to like take off again. So maybe I'm using too many metaphors here, but what I'm saying is it's going to be, you can get a soft landing, as in avoid a recession, but then you're not going to kill inflation.
But I wonder, Dhaval, because prior to the pandemic, we've had 2-3% inflation. I'm talking about the U.S. for a number of years. I think about a decade post GFC, and the economy was still growing. There wasn't a recession between 2009 and the pandemic. So, what was different back then?
So I think what it is that inflation is a kind of I call it it's a non-linear phenomenon. So what happens is when you've had a long period of very low inflation, it kind of gets embedded in people's psychology, because what they're doing is they're just looking at the long-term history or the 10-year history, let's just say, and they're saying, look, the 10-year history of inflation is very, very low, so we can just forget about it. So those inflation expectations are pretty well anchored, and that's really important for bond yields. But now we've got this sort of memory, this very recent memory of this very high inflation, and it's still in people's minds, and it's also in the history. So that people are going to say, well, okay, even if we get inflation down to say 2.5%, we had this big hump in the past. What's to stop that happening again? You're going to give me another inflation shock, and then you're going to sort of take it down, but you're not going to compensate me for that inflation. So people will demand a risk premium for that. If you see what I'm saying, and we didn't have that pre-pandemic, so that's quite a big difference. The actual experience of it has suddenly made people more frightened of what can happen in the future.
Well, what's going on with China? The slowdown in China, was that spurred by domestic issues, or was that brought on by the rest of the world slowing down as well?
But I think the bigger issue is that they have got I would call it the sort of the biggest housing bubble in history. I mean, it's kind of off the scale. And it's
You
really
mean
got to
their
the point.
history or just, all the world?
No, all world history. I mean,
Right.
it is the biggest bubble. We thought. I mean, if you cast your mind back to the late 80s, 1990, we had a massive bubble in Japan, a housing bubble, and we thought that would be the biggest bubble ever, based on any metric like rental yields, price to rent is the other way around, or just actual size relative to the economy. But no, China is off the scale even compared to Japan, and the numbers are staggering. That the total valuation of Chinese real estate is, conservatively $100 trillion, which is bigger than the global economy, twice as large as the next biggest real estate market, which is the US. And again, conservatively, I think there's about 100 to 130 million empty homes. So this is a really big problem now in China, which is they've sort of got this massive overhang of overvalued homes, and they just can't keep they can't keep building more. So given that construction was the big one of the big engines of Chinese GDP growth, and that has to obviously kind of cut out, it's going to be very difficult for the economy.
Is that bubble popping right now as we speak? The Evergrande collapse, was that just the beginning or was that the symptom of this bubble popping?
It's a symptom of the bubble coming to an end. But in China, which is really still very much a command economy, they will they've got a very high chance of avoiding the Japanese type of correction, or the 2008 housing sort of bust in the US. In other words, they'll manage it. They're going to try and manage it. But what this means, of course, is that it's going to be a protracted correction that will last many years, right? Because they're very conscious to avoid a 10-20% drop in prices, or, in 6 months or a year. That would be kind of a catastrophe for China. So to prevent that big drop in prices, they're going to have obviously a very controlled moratorium on new construction, which is going to last some time.
The $100 trillion valuation you brought up, I'm presuming that includes the ghost towns and all the empty apartments they've built that no one lives in, right? That's part.
Yeah, it is very much part of the equation, but it's really important because even though no one lives in them, they're owned, right? They are someone's investment. That's someone's life savings. That's someone's pension scheme. And that's really the problem, is that there's been this funneling of money into real estate almost as a kind of savings vehicle, on the assumption that prices just go up 10% a year after year after year after year until they don't, right? So it's just this sort of virtuous cycle that has suddenly come to an end, and that's a big problem.
How exposed are their banks to this real estate crisis? Are they going to see their own Lehman moment?
Um, See, I don't think that, again, in my view, the Chinese authorities will avoid what's called a Minsky moment, where you just have this big sort of collapse in something systemically important. To me, it is going to be much more of a sort of protracted slowdown. The impact will be stretched over many years. And what that means is that you're just going to get much, much lower growth rates out of China now. Gone are the days of 10% growth, gone are the days of even 8% growth. We're now expecting 4% growth
Can you just
if you're
explain the
lucky.
relation? Sorry, can you just explain the relationship between the slowdown in real estate, even though it may be protracted, um, to a slowdown in the real economy? What just because your home price or your investments are down, why would the economy necessarily slow down as well?
Well, there's two reasons. The most direct reason is that the actual home building industry, indirectly or directly, basically uh, accounted for a quarter of the economy. So 25% of GDP was in construction or infrastructure development, or in activities related to that, like banking or finance, right? So that was a high growth part of the economy. So if you say 25% of the Chinese economy is related to this sort of building of homes and the associated infrastructure, and that is no longer going to be growing at this phenomenal rate, then that's going to pull down overall GDP growth quite dramatically. And then, of course, there's the other impact, which is that if prices do go down even slightly, it's going to, the danger is it affects consumer psychology, and the fact that in China, the savings rate is quite high, and people say, well, that's a good sign because savings rate can drop, right? And you can spend more money. But the psychology, if you go from this situation where prices have been going up and suddenly they're not going up, they're going down slightly, then the psychology could be damaged and increase people's savings ratio. So there's two ways that it can hurt growth. But I think the first way, where simply this construction activity is going to grind to a halt, that's the most direct way it's going to slow the economy.
When the Chinese consumer spends less, or perhaps just stops becoming more wealthy at the same rate that they were in the past 2 decades, what does that mean for the rest of the world, Dhaval?
Well, I think the most important implication is that global growth, the rate of global growth is going to slow structurally, because this was the biggest engine of global growth. So, just as a sort of fact, over the last 10 years, when we think of, who has contributed to the growth of the global economy, 41% of that growth came from China, only 20% came from the US, less than 10% came from Europe. So what we're saying is the biggest engine is going to be cutting out. Previously, when a big engine cut out, a new engine came along. So when Japan cut out, China came along. So if China cuts out, we have to say who else is going to come along. And the only, people say, what about India? But at the moment, India is just too small to take up the slack. So what the bottom line in all of this is we've had global growth at around, over 3%. And it won't be 3% now. It's going to be more like 2.5% at best. That's quite a big impact, because we've had a very long period of global growth at as I say, 3 or above 3, and it's just not going to be there anymore. It has a major impact, on long-term demand for commodities.
Absolutely, yeah. Right. Can you just comment on base metals demand going forward? Copper, zinc, steel, right? All these industries, will they suffer?
Yeah, because the thing is, I know that there's a sort of very bullish case of new demand from, the energy transfer, the energy rebalancing, and decarbonization, and everyone's going to have electric vehicles, all that sort of stuff. So that's the sort of bull case. But in the near term, the lost demand from China is going to sort of overwhelm that. So that's the point. You just, again, to sort of reiterate this important point, China consumes, I think, something like 55 to 60% of global copper output, right? So, and as I said, most of that, or a big chunk of that, was for this construction boom. So we're going to lose, easily 10%, more of copper demand. So that's going to be very hard to fill short term from electric vehicles and the energy transition. So that it does have a big sort of structural impact on the commodity space.
Well, one sector that you think may do well despite a slowdown in China and perhaps abroad is the French luxury sector. You were talking to me about that offline, and I know you've written a few pieces about this. Why is that more or less insulated from, I guess, consumer demand waning in other parts of the world?
Yeah, so obviously there will be an impact from, if growth slows. It's not going to be
especially if the wealthy Chinese people who occupy the Champs-Élysées are no longer going there. I suppose that might take a hit, but please, yeah.
Yeah, so that's one of the key points, is that what the luxuries depend on is really the super wealthy. That's really the key point, because most of the increase in their sales, this may surprise you, is actually not volume growth. It's actually pricing power. And this is the key point is that if you're a luxury goods provider, you don't want that much volume growth, right? Because the whole point of a Hermes maxi bag is it's exclusive. You don't want everyone to have one of those, so you don't you don't want spectacular volume growth. And like it's complete opposite of Apple, because Apple would want everyone to have an Apple iPhone, but Hermes and LVMH don't want everyone to have their products. So their sort of sales growth is really to do with pricing power. And as long as you have this sort of group of sort of super wealthy, they can get away with that. So my point is, I don't see any, global growth is going to sort of come down relative to history, but at the moment, I don't see any major. I think that the forces that have kept the super wealthy are going to be there for the foreseeable future. And by the way, I think that the disruptive impact of AI will exacerbate this, because AI is not going to affect the super wealthy; it's going to affect the middle income jobs, right? So I don't see any sort of. I think I see less of a threat to luxuries than I do to some of these tech
That's a
valuations at the moment.
very interesting point, because during a recession, we know that consumer staples have historically outperformed. We know that stocks like Walmart have actually gained in prior recessions. But on the other spectrum, people don't talk about that as much, that maybe the super wealthy are not as affected by the recession as maybe the middle class. And perhaps the two ends of the spectrum, you got the consumer staples doing well, and also the ultra luxury brands also doing well. Would you say that things like LVMH are recession proof? Would you go that far?
I wouldn't say they're completely recession proof, because I think that so one of the things that for the sort of super wealthy, asset prices matter. So if you get a really deep sort of collapse in stock prices and real estate prices globally, then yeah, you're not going to you will get impacted. But what I'm saying is the forces that have created this sort of massive polarization of wealth haven't gone away structurally. So you will get hurt a little bit. If it's a nasty recession, they're not going to be completely recession proof. But the real sort of the thing that would devastate luxuries is if this polarization of incomes and wealth came reversed. If we sort of all went, if the world turned socialist, that would be the end of luxury goods. But that's not happening.
Okay. Yeah. No,
That's
it isn't.
unlikely to happen in the near term, or even in the
Right.
next year, over my investment horizon.
Well, do you have any insights on who the primary target demographics of these luxury brands are? I brought up the Chinese tourists in Paris, because that was the case. That you have wealthy people from the East, the Far East, and the Middle East buying these things. Is that still the case going forward?
Yeah, I mean it is. I mean, but what's interesting is, and again, if you look at so LVMH as an example, that's not overexposed to China. It's got actually China's whatever 18% of global GDP, but LVMH's sales to China are less than that. So yeah, it's part of and obviously China's obviously been a big growth engine. So it's been a big growth engine for most companies, just because it's been a growth engine for GDP. On the other hand, Hermes has got a high exposure to China, so it's a different story for each stock. So Hermes would be more exposed to if China had a very very severe slowdown, or here's the other risk: is if they suddenly the Chinese authorities, just as they said, look, we're banning the sale of iPhones. If they said, look, we're banning the sale of French luxuries, then that'd be a big problem for some of them. But I don't think that's going to happen, or it's less of a risk to me than the banning of tech.
Well, we're turning back to the U.S., and we'll close it off here, Devil. I think people are wondering whether or not they could afford to buy any luxury goods at all. And I'm talking about the labor market. People are worried about losing their jobs. They're worried about the unemployment rate ticking up later this year or next. Is that a legitimate concern at this point based on your evaluation?
Yeah, because look, here's the thing. Look, we know that the labor market is pretty strong at the moment. I'm not disputing that. But the fact is, in the last year, there has been roughly a 500,000 increase in unemployment. That's a fact. Whether you look at the continuing claims or whether you look at the household survey in the jobs data, it's about a 500,000 increase. That's not a lot. But here's the thing: the fight against inflation is only half done at best, right? So if you're going to fully win the war, then and it's cost 500,000 so far, then it's going to cost another 500,000, right? So that's a million, right? But that it doesn't end there because what happens in the labor market is it's like this sort of non-linear system again, which I've referred to. So what happens is the unemployment rate sort of edges up, edges up, edges up slightly, and then suddenly it goes up. So what I'm saying is that if you got to a million, a million more unemployed, you'd be at that tipping point where it just suddenly shoots up. So here's an interesting fact, and the listeners can check this out. In the US, the unemployment rate has never gone up by just 1%, right? So what I mean by that is that it either doesn't go up at all, it sort of goes up by 0.5% or less, and it's just sort of you don't ignore it. Well, when it gets to a 0.5%, it then doesn't stop there. It just goes up to 2 or 2.5. So there's never been an example in history where the US unemployment rate has just gone up by 1%. So that's my sort of point is that, yeah, it's sort of at the moment, it's no one's really worried because it's gone up by whatever 0.3, 0.4 from its low, big deal. But then once it gets to a kind of a tipping point, not that far, then it normally tends to go up quite sharply.
I ask because if you just look at the trends of some other indicators for the labor market, they seem to be improving somewhat. Initial jobless claims have been trending down in terms of growth. The labor force participation rate has been trending up. So it seems like the labor market is strengthening, not weakening. Would you agree or disagree with that statement?
No, as I say, I disagree because I think the thing I'm looking at is just look at look at the continuing claims. That's the best metric. Is that people who are sort of not just it's not their first week, is that they've been sort of claiming benefits for a few weeks. That is, as I say, 500,000 or maybe 400,000, or certainly close to 500,000 higher than it was a year ago, right? And also we're seeing job vacancies are starting to come down. So we're at the sort of start. There has been some cost in the labor market of fighting inflation, but it's not been very large so far. But the point is that the war against inflation, we're only halfway through it. So there will be more cost.
At what level of the Fed funds rate would be sufficient to bring down inflation to the Fed's 2% target? I'm talking about the core PCE, which is still above 4.
Well, this is something that if we knew the answer to this, the Fed would be rejoicing. It's a sort of it really is trial and error.
Right.
The Fed, no one knows for sure because as I say, it's a complex system. There's all these sort of feedback loops, etc., etc. And we don't know the level because we don't know what level is tight or we don't know exactly how tight it is, nor do we know the lags in the system precisely.
Do we know at what level the economy would not be able to sustain growth? In other words, after a certain point, there will need to be contraction and things will fall apart and more things will break.
Well, the one thing, as I say, one thing we do know is, as certainly from my work, there is this very good in my view, there's still this good connection between the state of the labor market and wage inflation. And we know that wage inflation is probably the most sticky part of inflation that the Fed needs to address. So what I'm really saying is the thing that we do know, or certainly looks still like a good relationship to me, is that we're not going to conquer wage inflation until we get a much tougher labor, much harder, much looser labor market. So there's more work to be done in the labor market. It's not, if the labor market stays as it is, we're not going to win the war against inflation.
More people need to be laid off before inflation comes down.
Yeah, because I don't think, I mean, just based on all the analysis, the labor market is not going to loosen sufficiently without some further increase in unemployment. So that's really the hard choice, which is, yeah, the Fed can say, look, we don't want any more unemployment from here, but then wage inflation will be too high for the 2% inflation target.
If we were to engineer, let's say we both worked at the Fed and they're trying to solve this problem every day, if we were to engineer some sort of Goldilocks scenario that is not a fairy tale, some sort of scenario where there is just a natural slowdown of the inflation rate without unemployment ticking up by more than 1%, let's say, what would they need to do? Is that something they could control?
Well, the one thing that could do that and save the day is if you had this sort of productivity miracle, right? So this would be like the sort of dream scenario where you say, actually, this sort of rolling out of Chat GPT is going to boost productivity so much that we square the circle. But I think even that I think is overdone because I think the sort of productivity enhancing aspect of AI maybe it will come to pass, but it's not going to happen in 1 year, in my view.
Let's close off on this. One of the things that you do that's unique to your work from the other economists. I haven't seen anyone else do this, but you do fractals. You analyze fractals for price patterns, and I'll let you explain exactly how this works because you'll probably give a better explanation than I can. But I just want to bring up the fact that we spoke a few months ago. You were using this analysis to make the prediction that gold was already overbought and that we could see a price correction imminently, which we did. So that was, a perfect call. So maybe give us an update on some of the things you're tracking with fractals and explain briefly how it works.
Okay, I'll just explain simply how it works. And what we're looking at here is this idea of complexity. So if a market, if a sort of price pattern is complex, that's good because it's healthy. Because in simple terms, the financial markets are known as a complex adaptive system. So we want the complexity because otherwise it's not a complex adaptive system. So that's what we're doing. We're looking at the complexity. When that complexity breaks down, it's normally like a red flag. It's a warning sign that the trend is about to change. So that's the essence of it in one sentence. So at the moment, we'd sort of say that the strong rally in stocks versus bonds is losing its complexity. So that would mean I'd be holding off before putting a bigger new amount of new money into stocks versus bonds. That's one thing, and most of that is due to this the tech sector. So we're seeing breakdown of complexity, and we saw it in Apple, we're seeing it in Nvidia, the usual that sort of magnificent seven. But on the flip side, where where we are seeing a sort of buying opportunity is on the dollar against certain crosses, particularly the LATAM crosses. And the one that actually stands out to me is the dollar against the Mexican peso, because the dollar has actually sold off very, very substantially against the Mexican peso over the last year or so. So we haven't, the dollar, everyone's talking about dollar strength, but it's only starting against some of the LATAM crosses. So that's what the complexity analysis is showing. There are some good long dollar opportunities at the moment.
Okay, excellent. Where can we learn more about your work and read? Perhaps if we want to learn more about fractals, we can do that. Where do we do that?
So just go to BCA Research. The website and the product that I write is called Counterpoint. So it's bcaresearch.com and then click on the Counterpoint. Obviously, there's other products there, which are my colleagues are also writing interesting stuff. And I think some of it is accessible to everyone, and then some of it obviously is behind. It'll be behind a paywall, but that's the way to find it.
I've always wondered actually, why is it called Counterpoint? Was that your idea? Why is it?
It's basically counterpoint to the Wall Street groupthink. Put it like that.
Okay. All right.
So,
So you would you characterize yourself as a contrarian? Would you use that word?
well, in a general sense, yes. I mean, I wouldn't say I'm a contrarian in terms of the investment recommendations may sometimes be contrarian, maybe not, but the approach, the way we look at markets is very contrarian. It's a very counterpoint way where we place emphasis on things like psychology, as I said, nonlinear systems, um, statistics. So we're just saying that economics and finance, yeah, that's important, but there's a lot more to what drives markets, and we place more emphasis on these other, let's say, softer subjects, which are hugely important.
Okay. Yeah. I'd love to chat with you more next time about applied behavioral finance. That's another area of focus you have. But all right, Dhaval, excellent chat as always. Thank you very much. I appreciate your time, and we'll speak again soon. Thank you.
Thank you.